This is Matthew Cratter from Bitcoin University, and today I wanted to answer the question, could BlackRock destroy Bitcoin? We're going to be talking about the new Bitcoin ETF, which hasn't been approved yet by the SEC, but almost certainly will be given BlackRock's track record in getting ETFs approved. I am calling this a BlackRock Bitcoin ETF, even though I'm quite aware that it's technically structured as a trust. It has many of the same features as an ETF, though, and it will have daily liquidity, daily creations and redemptions, so it really does function quite a bit like an ETF. Now, this is an opposite video to the one that I made yesterday, in which I talked about all the good things about BlackRock entering the Bitcoin ecosystem and buying a lot of Bitcoin. I'll link to this in the description notes below. BlackRock blessing Bitcoin super bullish. And just to recap, what are the reasons it's bullish? It's going to mean really large capital flows into Bitcoin, which will probably allow Bitcoin to hit new highs in the 12 months following the approval and trading of this ETF. It's also, BlackRock entering the space is also validation of our long-held position that Bitcoin will not be banned in the US anytime soon. BlackRock confers an air of legitimacy to Bitcoin as an investment for corporate balance sheets, retirement accounts, etc. And also by creating a Bitcoin ETF, BlackRock is implicitly giving its blessing to Bitcoin as an ESG-friendly investment, which is, of course, what it's been all along. So those are all the bullish reasons. In this video, I want to talk about some of the darker questions that some of you had. Could this actually be a bad thing for Bitcoin? Let's consider the possible downsides to BlackRock becoming a large player in this ecosystem. What could go wrong? For example, what happens if the BlackRock ETF is successful, accumulates a lot of Bitcoin, and then BlackRock or its custodian, which is going to be Coinbase custody, loses all of that Bitcoin in a hack, or it somehow disappears? This isn't a problem. What they did is, if this were to happen, they would just have made a pro-rata gift to Bitcoiners everywhere if this Bitcoin was destroyed or disappeared. And here's a quote from Satoshi from 2010 from the Bitcoin Talk forum. Lost coins only make everyone else's coins worth slightly more. Think of it as a donation to everyone. So I don't think that's a real concern. Another possible concern, could BlackRock attempt to suppress the price of Bitcoin by issuing quote unquote paper Bitcoin through the BlackRock ETF? Now, paper Bitcoin is just a Bitcoin IOU. It's any Bitcoin that trades that's not completely backed by real Bitcoin sitting somewhere in a custody vault, for example. So yes, theoretically, this is a problem. This is something that FTX already did. I don't think FTX was trying to suppress the price of Bitcoin, but they were basically letting customers think that they had Bitcoin in their account when there was no Bitcoin backing it up. In fact, they owed customers $1.4 billion worth of Bitcoin that they did not actually own or have on the books. We're going to talk a little bit more about that, but I'd ask you just to help to support this channel's mission by hitting that subscribe button, hit the like button, and leave a question or comment. Jesse Myers here has a great tweet about FTX and paper Bitcoin. 330,000 Bitcoin mined every year. FTX had 1.4 billion in Bitcoin on the books, meaning approximately 80,000 Bitcoin at the price back then. Assuming incurred this year means that FTX increased the Bitcoin supply issuance 25% this year. Others likely did the same. No wonder we're under prior cycle highs, having math interference. But what happened here was that FTX did end up blowing up. And when FTX blew up and it became clear that FTX could not make good on its promises to pay Bitcoin to customers, this paper Bitcoin was essentially destroyed. And this is one reason that Bitcoin has rallied since FTX's collapse. Now, paper Bitcoin or Bitcoin IOUs do not, in fact, increase the actual supply of real Bitcoin, which is fixed at 21 million, but they do increase the supply of the summation, real Bitcoin plus Bitcoin IOUs. Now, if we can train everyone to only accept real Bitcoin and do self-custody, this won't be a problem. But if people get used to the idea of leaving their Bitcoin on apps or exchanges and not holding their own keys, this could become a problem. Again, anyone can create Bitcoin IOUs, not just BlackRock. So it's not just a problem with BlackRock entering the space. And I would say that all the economic incentives would encourage BlackRock not to engage in Bitcoin price suppression. After all, they will be getting paid a percentage of the Bitcoin ETF assets under management. And so if Bitcoin's price moves higher, they will see more people buying into their ETF. They'll also see the value of those assets under management be higher as well, because the price of Bitcoin will be higher. And so their management fees as a percentage will be higher as well, or the percentage will be the same, but the absolute amount of management fees will be higher. So all the economic incentives lead to lead to the direction of BlackRock wanting Bitcoin's price to move up. Obviously, BlackRock could be pressured by the U.S. government or another government to ignore these economic incentives and try to suppress the price of Bitcoin. And that is definitely a possibility. We'll talk a little bit more about that in a minute. But one thing is certain, that central banks are not going to want to own paper Bitcoin. Nation states like El Salvador are not going to want to hold paper Bitcoin. Billionaires are not going to want the counterparty risk that comes with holding paper Bitcoin. And serious Bitcoiners like you and I are not going to want to hold any paper Bitcoin. In addition, for companies like this, issuing paper Bitcoin comes with very large risks, because if enough people ask to convert their paper Bitcoin into real Bitcoin, in other words, withdraw from BlackRock's ETF, and BlackRock doesn't have enough real BTC backing up those BTC IOUs, then BlackRock would need to go into the open market and buy real BTC. And the resulting spike from this huge buyer entering the market would cause a short squeeze almost certainly that could easily bankrupt BlackRock or any other company that tries to engage in this. Now, as many of you gold bugs or former gold bugs know, paper gold is probably, in other words, gold IOUs or ETFs that aren't backed by gold. Paper gold has probably been responsible for suppressing gold's price and its miserable investment performance over the past decade, but it is much more difficult to suppress the price of an easily portable digital commodity like Bitcoin than it is to suppress the price of a bulky physical thing like gold. And most gold is sitting in bank vaults already. Taking delivery of Bitcoin takes 10 minutes or so. Taking delivery of physical gold takes a lot more time, a lot more money, and a lot more coordination. I talk a little bit more about the dangers of paper Bitcoin in this video, which I will link to in the description notes below. Another critique of BlackRock entering the space was provided by Chris Black, and many of you sent this to me. BlackRock runs first and largest Bitcoin ETF, becomes wildly successful, heavily funds Bitcoin development, in other words, Bitcoin core software and the devs, proposes quote-unquote regulatory and eco-friendly proof-of-stake fork, loses community opinion but adopts fork as Bitcoin anyway, as do most governments. Proof of work, in other words, the original real Bitcoin, becomes just a fork for pirates and rebels and El Salvador. And then Anil pointed out that in the BlackRock ETF filing, there is this risk disclosure that the sponsor, in other words, BlackRock, will use its discretion to determine which network should be considered the appropriate network in the case of a hard fork, whether caused by BlackRock or not caused by BlackRock. There's no guarantee that the sponsor will choose the digital asset that is ultimately the most valuable fork. And this is always the problem with running an ETF. If there is a fork, you have to decide which side to go with, because you can't have one share of the BlackRock ETF providing you one Bitcoin on one network and a fake Bitcoin on another network. So these are the arguments for a BlackRock proof of stake hard fork that could be forced on everyone. And it's important to remember that anyone can fork Bitcoin, not just BlackRock. You don't have to be especially powerful to do this. You just copy and paste the code from GitHub, you change a few things, and the hard part is not changing the code, though creating proof-of-stake code is quite difficult, as Ethereum saw. But the hard part's not changing the code, but convincing Bitcoiner node operators to run the changed code. And this is always the problem with forks. You have to have widespread community support for them, or no one will run the upgraded software. That part is basically impossible, convincing Bitcoiner node operators to run the changed code, especially if each Bitcoin node operator has an economic interest in Bitcoin, i.e. owns some BTC, and is thus incentivized not to run any code that would hurt the value of his or her BTC. And I would personally never run a proof-of-stake version of Bitcoin on my nodes, neither would any other serious Bitcoiners. If BlackRock were to fork Bitcoin into a proof-of-stake version, what would happen most likely is all of us would get airdropped Bitcoin proof-of-stake tokens on this new BlackRock network. We could then dump those tokens on an exchange or sell them elsewhere for real BTC and use the proceeds to buy more real BTC. So I say, please fork Bitcoin. If you want to, send me over my proof-of-stake tokens, and I will dump them for real Bitcoin. This is not just a theoretical exercise. This is exactly what happened when Bcash, BCH, forked away from Bitcoin in 2017, and the result has not been kind to this hard fork of Bitcoin. BCH against Bitcoin has completely collapsed and now has a tiny percentage of Bitcoin's market cap. This is basically a failed hard fork, and I would expect a BlackRock hard fork to end up the same way. So the conclusion is BlackRock, or really anyone else, can fork Bitcoin and run it and run their own version of the Bitcoin network. But we don't have to play ball with them, and miners don't have to participate. Bitcoiners don't have to participate. We'll just keep playing. The metaphor I like to use is this basketball metaphor. Real Bitcoiners will just keep playing NBA basketball, and BlackRock can go off in a corner and play donkey basketball with its fiat friends. Donkey basketball, you can fork the rules of basketball, but you don't end up getting all the fans, and you don't end up having a real sport. It becomes more of a niche or a novelty thing. And I think when Chris Bleck is worried about the proof of work fork just for pirates in El Salvador, in other words, the original Bitcoin that we have right now, I don't think this fork, or basically original BTC, will just be for pirates and El Salvador. I think it's going to be for anyone, including you and me, anyone who doesn't want BlackRock to control their money. Freedom-minded individuals like watch this channel, billionaires seeking to escape the tentacles of the U.S., nation states, foreign central banks, etc. They're not going to want to lock themselves into a proof-of-stake protocol and give control to BlackRock and or the U.S. government. That's a lot of capital there between billionaires and nation states and foreign central banks, and they're not going to want to house themselves inside or house their capital inside of the BlackRock or government-controlled walled garden. So here's the conclusion. If BlackRock forks, it's not a big deal. If BlackRock doesn't fork and just owns a lot of BTC on the real network, it's also probably not a big deal. Because Bitcoin is proof of work, as we've discussed many times on this channel, owning more coins in a proof of work system does not give you any additional control over the protocol. You don't get to make the blocks and decide the transactions as you do in Ethereum under proof of stake. This is not true for proof of stake. Owning more coins in a proof of stake system does give you a lot of additional control over the base layer. And this is why a BlackRock ETF for Ethereum would actually be disastrous, unlike a BlackRock ETF for Bitcoin. But of course, everything about Ethereum's construction is a complete disaster from beginning to end. So Ethereum's better hope that BlackRock doesn't do this for Ethereum as well. But for Bitcoin, I think the risks really are minimal. But I do think this is something we're going to have to pursue. We're going to have to continue Bitcoin education so people understand the differences between a walled garden BlackRock proof of stake Bitcoin and the real Bitcoin. And even if people don't understand this, they'll ultimately end up getting rugged. Their coins will be stuck with BlackRock, and they will be stuck in a protocol that loses massive value against the real BTC in the same way that happened with Bcash. If you found this video helpful, be sure to hit that subscribe and like button. Hit the notification bell if you want to be notified when I publish a next video. And let me know your questions and comments in the comment section below. Thanks a lot for watching, and I'll see you in the next video.